Hello, today we're going to talk about costs, and a company we're going to focus about is HTC. HTC, as some of you may know, they produce some really cool phones, and today we're going to look at the costs of the company. Look at this diagram here. We see a straight line here. This straight line is the total fixed cost. You see, as the output increases, cost stays the same for the business. The total fixed cost stays the same for the business. Now you may ask me, what are the examples of total fixed costs? Total fixed cost includes the followings. Let's return to our example, HTC. As they produce 1 more unit of phones, it's still the same machine, same rent they're paying, same insurance they're paying, same salaries they're paying, same advertising costs they're paying. Producing 1 extra unit will not increase their total fixed costs. Now look at this diagram here. This diagram is a variable cost diagram. As you can see, as the output increases, the variable cost of the company increases proportionally. Now, what are the examples? Return to HTC. Now, you produce 1 more unit of phones, your machine runs longer, you need to pay more electricity. You also need more raw materials like more plastics, more of the electronics, and also more wages and more transportation costs. Obviously, you need more vehicles to transport the phones if there are many more phones that you are producing. Now, you may ask, why does salary exist in the total fixed cost and wages include in the total variable cost? Now, salaries is actually a fixed amount that you are paying to your workers, while wages include more like the piece rate, time rate. It varies according to the output, how many units of phones you are producing. Let's say you're producing 50 units. Workers work for 10 hours. If you're producing, say for example, 1,000 units, then obviously your workers is going to work way longer. And wages will therefore increase and variable costs will increase. This diagram is the total cost diagram. You may ask me, what is the difference between this diagram and the variable cost? Or how does it come from? Look at this. This diagram, remember, this diagram is the variable cost diagram. You can see as the output increases, the variable cost increases. Now, if we add the fixed cost, then the variable cost will increase. Why? Let's say in the beginning point, when it is supposed to be 0 in the variable cost, if they increase a fixed cost of $50, then it will be 50 plus 0. Now, in the middle of the output, let's say 20, the variable cost is supposed to be 30, but you also have to add the fixed cost of 50. So the total cost would be 80, 80. So total cost equals to total fixed cost plus total variable cost. This diagram illustrated in a more clear way. Total cost, as you can see, the line in there, the total cost, if we deduct it from the fixed cost, the region you get over there, the shaded region, is the variable
Now, ladies
cost.
and gentlemen, finally going to our final diagram here. We'll talk about direct, indirect, and semi-variable costs. Direct costs are costs that are linked directly to a project. In other words, they are variable. They vary proportionately to the output, the amount of output that you are producing. Let's take HTC's latest phone, HTC Evo 3D, as an example. Let's say the market is happy about this product, they're happy about this phone, and they want more. So HTC need to produce more. In other words, the electricity cost attributed to HTC Evo 3D, the raw materials attributed to HTC Evo 3D will increase. They are variable costs. They vary directly to the amount of HTC Evo 3D you are producing. Now, indirect costs in HTC are the costs that are not linked directly to a project. Examples include tax. It doesn't matter how many ventures that your company has, no matter how many new phones that you're putting out, the same tax that you have to pay. Semi-variable costs are costs that have a fixed and variable element. Salaries in HTC, if in this system, would be a perfect example. Let's say they pay their workers using a basic pay plus overtime bonus. The basic pay, i.e. the salaries, are fixed costs. it doesn't take into account how many extra hours or how many extra unit the workers are producing. It is fixed, let's say, at $10,000 per month. That is the fixed element. But HTC decides to motivate the employees, so they're giving them a overtime bonus if they're required to work overtime. This overtime bonus varies according to the output. It is a variable cost. So the salary plus overtime, this payment bonus, this payment system in HTC is a semi-variable cost. That's it, ladies and gentlemen. That's all about the cost. Thank you.